use money to make money. Okay, of course, it's not smooth sailing. Lost money here and there. They call it pay school fees, right? So that was how I figure out, right, what works, what don't work, and eventually that's where I progress to third stage. Okay, after you pay the school fees, you realize, okay, this is what works, right? But this is only one of the many methods that work. There's another method that works. Okay, so and at this stage, I have multiple strategies running, and it is painstakingly figured out through all this trial and error, through paying school fees in the market, and of course, not forgetting learning from a lot of other people out there. They taught me some of the things that to give me some foundation, right, or point me in the right direction to explore. Okay, so it is that how to say, investors also like to help other investors. Okay, this kind of community that I figure that well, that makes the journey easier. Okay, I wouldn't say that it's easy, but easier. All right, so today I'm going to share with you just one of the methods that I do. Okay, and it is more with respect to short-term trading. All right. There are merits of it. Some of you may think that, oh, I'm just going to be a long-term investor. I'm not going to be a short-term investor. Don't worry, because there are some principles that can also be adopted for long-term investing. Okay. But primarily today, I'm going to talk about short-term trading. All right. So this is what I'm going to cover. I broke down into 4 parts. The first part is to know which stock to buy. Okay, because there are over 10,000 stocks out there in the universe. Okay. Which stock to buy is something that you need to quickly filter down. Otherwise, you'll be always looking at the wrong stock at the wrong time. The second thing is to know when is the best time to buy a stock. Okay, because when you do short-term trading, you are engaging in market timing. Okay, there is a right time to buy a stock, right? And there is also a wrong time to buy a stock, right? So knowing the best time to buy a stock is also very critical. Okay, I'll give you very important frameworks for you to apply. The third is to know when to sell. Okay, a lot of people actually know how to buy a stock, when to buy a stock, right? But most people, through my last 10 years of interaction with other investors, I can tell you more than half of the people don't know when to sell it. Okay, they will either hold a stock too long, hold a loss too long, or they sold the profit too fast. Okay, so very, very typical. And I would think that this itself would be worth your time today. Okay, knowing when to sell. And lastly, I want to introduce you to this concept called turbo stock trading, which is essentially combining everything together to become a workable strategy. All right, sounds good. Okay, so let's begin. And let's talk about what are some of the pitfalls, okay, that most investors may experience or encounter through their trading or investing activities. Okay, one of it is that sometimes a stock price can really slump for a long time, and they can remain undervalued, remain low for a long time, or at least longer than what you expected. Okay, and that itself is long enough, right? So, example is like Alibaba has been undervalued, right? You ask a lot of investors, you value Alibaba, is it undervalued? Majority of them will tell you it's undervalued, but yet the share price just refused to go up. It's been range bound for 2 years and counting. And don't forget about that down year in 2021, right? So altogether, it's about 3+ years already. Okay, 3+ years, the share price have not moved up. Okay, so the worst is that there are some other stocks that go up, right? And then people will feel that, hey, I missed the opportunity. This become an opportunity cost of holding the stock. And it is not just China stocks, right? Because it's very easy to nitpick on China stocks. But if we take a look at even US stocks, there are stocks that slump for a long time. PayPal, right, is a well-known name, used to be a glamorous stock and in a very exciting space, payment, fintech, and it has one of the largest market share in terms of digital payments. And yet the share price have also slumped and never moved for years. Okay, and the slump is a big one. It's more than 50% down. Okay, so things like this, right? And sometimes you feel that, oh yeah, I'm a long-term investor, but how long is going to be for this long term? Okay, when is the share price going to recover? And of course, if you have a choice to rewind back in history and you know this is going to happen, what would you do? Right? You will sell the stock and move the capital to some other stocks, right? Let's be honest about it. Okay, so therefore, there are times where we should sell a stock, okay, which I will go through with you later. Okay, but I want to talk about some of these issues when even comes to buying a stock when it's undervalued, you can still get stuck, right? Not just about selling before it crashes, okay, but also buying and get stuck for years. For example, there are also stocks that pay dividends, right? So some people will say that, yeah, but never mind, I'm a long-term investor, I get dividends every year, okay? And Hong Kong Land is one example. It always trade below its book value. And Hong Kong Land is not difficult to value because it is a property company. It has a lot of prestigious properties around Asia, and they are valued by real property valuers every year. And if you count all their properties value and convert into a share price basis, is about $14. Okay, and you can see the share price never crossed $6. In other words, um, if they are selling a properties, they are selling you below half price of value, below the half of the valuation, which you know in real life it will never happen. One. How would they sell you, say, MBFC, right? Below half the valuation. It's not going to be possible in the real world. But in the stock market, these kind of things can happen. Okay. And if you bought Hong Kong land, you hold over 10 years and you collected dividends every single year, you're still down 30%. That is after you collect dividends. Okay, so therefore, there are a lot of all these what people call value trap. Right, it is cheap, it's always undervalued, it's perpetually undervalued, and the share prices refuse to go up. And if it doesn't go up, how are you going to make a profit? Right, and the dividend is not even enough to recover the price that the price drop. Okay, so cases like this are actually a plenty. So my realization is that it doesn't matter. You want to argue there's a growth stock better or value stock better, but you will find enough examples. There are growth stocks that slump for a long time. There are value stocks that slump for a long time. Okay. And at the end of the day, as an investor, there are only two ways to make money. Right. So one way is the dividends, is the dividend gains. Okay. But make sure the share price don't go down. Okay. If the share price go down more than the dividend, you actually lose money. Okay. And the second thing is capital gain, right? And for capital gain, you need the share price to go up. And we also established, even if you go for dividends, you have to make sure the share price don't go down, right? So in other words, you would have to take care of the share price movement, okay? You like it or not. All right. Even buying well-known blue chips at undervalued prices will just be hits and misses, as we see just now. The stocks that I mentioned just now, the three of them are well-known blue chips. Okay. Yet you look at them today, they're still stuck there. All right. So how do we then figure it out? It's not that fundamental analysis is not useful. Okay. I am schooled in the fundamental analysis for extensive period as well. I still use fundamental analysis in a very extensive way, right? Just not for short-term trading. Okay, because in the short term, sentiments is more important than fundamentals. Okay, in the short term, in the long term, it's the other way around. In the long term, fundamentals are more important than sentimentals. Okay, because greed and fear will eventually subside. And it's the fundamental value of the company that drives the share price in the long run. But in the short term, fundamentals doesn't play a very big role. Why? You think about it, how often do you get your financial statements? Once every quarter, max. Okay, some even give like once half yearly, okay, which means you get two times a year, right? And therefore, your share price movement in between financial reports, right, cannot be explained by business fundamentals, especially when there's no announcement, no news from the company. How do you know the fundamentals have changed? Nobody knows. Okay. And it is the sentiments or supply and demand for the stock that drives the share price in the short term. That's it. Okay. When you invest or when you trade the market, especially the stocks, you will also experience this thing called earnings. Okay. Companies will release their results. Like, for example, I don't know whether you all follow. Yesterday, Alphabet released their result. Tesla released their result. Good or bad? Good or bad? Anyone follow or don't care? Anyone follow? Sure have one. Some of you sure have followed. Anyone? Was it good or bad for Alphabet and Tesla? Google good, Tesla bad. Yeah, okay, correct. But even when Google meet the expectation, the share price was down 2%. Okay, Tesla was down 8%. So you will inevitably meet some of this earnings season, what we call, okay? Every quarter you have this, right? You cannot, for investor, you definitely will hold through the period. Okay, for traders, you cannot really avoid it altogether because the earnings will spread over 1 month plus, right? Then how? You don't trade for the whole month. Okay, so not really practical, right? So you'll meet some of this earnings season, and sometimes the earnings can help you because the share price can have a boost if the earnings is good. So how do we use FA in the short term or fundamental analysis? FA stands for fundamental analysis in the short term to help us, okay, get a better chance that the earnings will do well. Anyone spotted? Anyone saw Spotify yesterday? Anyone? Was it good? Was the earnings good? Spotify. And some of you might even have Spotify accounts. You have a paid plan. Okay, if you don't get a paid plan, you also get served advertisements, which Spotify also make money. Anyone? Don't know. Okay. So sometimes there are actually a lot of stocks, but most people they don't follow majority of stocks, right? You only follow a handful of stocks because of time, because of interest, because of your portfolio exposure, basically. Okay, Spotify did well. 10% growth again. Profits was up 20%. The share price jumped, I think 12 or 13% yesterday. Okay, just because of earnings, right? So in cases like this where you can see that 1 day return, right, can be more than a 1 year return for another stock. Okay, so there is some benefits in identify some of these stocks during this kind of earnings season. Okay, now is the earnings season, right? Yesterday kick-started Alphabet, Tesla for the big tech. Okay, on over the next 1 week, you will see the rest of the big tech reporting their results. Okay, so it's an important period now. And how do we then help us to help ourselves, right? Is to use this quarter-on-quarter growth, okay? Revenue or earnings. I would argue that revenue is more important. A lot of people will understand when I say momentum, they will relate it to technical analysis, right? Or trend following or momentum trading, whichever. Okay, usually it's more technical in basis, not so fundamental. But actually, people don't know that momentum applies to fundamental analysis as well. Okay, when a stock is experiencing revenue growth, there will be momentum for it to report better results in the next quarter and the next quarter. Okay, what is one example you can think of? Has reported good results in the past, strong growth, and the next few quarters results growth, the growth continues, sometimes even accelerate. Come, name one stock. You all cannot don't know one. Yes, Nvidia, right? Nvidia is a good example of this. And then when earnings results come out, big expectation, surprise, the share price jump up even further. Okay, so fundamental analysis have this momentum too, right? If they have exhibit his recent quarters revenue growth, there is a chance or the probability is higher that the momentum will continue to deliver better results in the coming quarters. Okay, so they tend to produce earnings surprise and therefore the price start to spike, right, during earnings result. So I give you some examples, okay, but these examples, some of them may not be valid today, right? I want to make sure you focus on this part first. Okay, this is the revenue, right? Every quarter you can see about 3 months. They will have one revenue figure. This was June. Then September they report another growth. That's why the revenue jump. Then another quarter the revenue jump. Okay, and this is what I mean by there is a momentum. You can see that it continues. Okay, it continues to deliver that growth, and likely you are using this trend to predict that the next revenue or earnings growth would also be consistent as the past. Okay, so this is another example, right? You can see, in fact, you can see the gap widen. When a gap widen means that there's an acceleration, right? There's acceleration in the growth. Okay, so the bigger the step, the better it is. Okay, and you can see what happens, right? The stock reported 18%. Okay, this was here, right? You won't know the results yet, but you have a clue because previous quarters have done well and there was acceleration in the revenue growth. Okay, so there is a high chance, or not say, I won't say high chance, there is a chance that these earnings can be a beat. And then indeed, it did a beat and it up 18%. Okay, so what I'm trying to say here is that FA can be used in the short term. Okay, initially, I show you some of the long-term holding stocks. A lot of people use fundamental analysis. They will do valuation and things like that. Okay, yes, right? You have to use fundamental analysis for the long term. And a lot of people will say that fundamental analysis is not useful in the short term. It's not true, right? There is one component that we can use, okay, that can help us in this earnings season, which is the acceleration or the momentum in revenue growth. Okay, from quarter to quarter, not year on year, quarter to quarter. All right. And FA alone is not enough. Okay, because I also mentioned that in the short term, technical analysis is more important. Okay, the sentiment that drives share prices is stronger than the fundamental value. Okay, the FA will only be useful on a quarterly basis or half-yearly basis. Okay, but TA is important throughout. Okay, so that's why you cannot do one without the other, even when you do short-term trading, especially when it comes to stocks. Okay, the FA will make the TA more reliable. Why? Because if a share price is going up, right? If the share price is going up, and it is because there's really real growth that is going on, the trend tends to be more sustainable. There is a reason why the share price is going up. Is powered by real fundamental improvements. Okay, so FA will help TA to become more reliable, and the reverse is true as well. FA confirm the fundamental analysis is correct. Okay, let me ask you, have you seen before the fundamental analysis, right? Okay, or maybe let's talk about earnings. Okay, earnings go up, share price come down. Anyone have seen this before? Anyone have seen this scenario before? Yes, right? Very common. Okay, then people will start to scratch their head. Why? Why like that? Yeah. So sometimes it's more complicated than that. It's not just the past results. The forward guidance is also important. Okay, if the guidance or the outlook is not good, the price will also go down. How about the other case, right? Price go up, but the fundamentals or the revenue goes down. Is this good? Is this good? What do you think? Is this good? Fundamental go down, price will go up. Yes, no, yes, no. Don't worry, no punishment if you get it wrong. No reward when you get it right. It's just for participation purposes and learning purposes, right? You learn better. This case, fundamental go down, let's say revenue go down, but the share price go up. Is this good? Yes or no? Okay, thank you, Ivan. No, right? So you get the idea, this is no, okay? Because your TA and FA is not agreeing with each other. This is also no, because they are also disagreeing with each other. What do you want to see? You want to see the price go up, and you want to see the fundamental reason going, there's a fundamental reason, right? The fundamental analysis to say that is good stock, okay? It's accelerating in terms of its revenue growth, okay? So this is what we want to find. Because with these two alignment, you will get a higher probability of success. Okay? And, so now let's move on to the technical analysis part. Okay, not all are well versed with technical analysis, but I wanted to introduce you to some concepts. Okay, you will learn a few technical indicators. More importantly, how to read the chart, right? Rather than indicator, it doesn't mean anything. You do really want to see or interpret the movement. Okay, so one of the key thing is this momentum concept. It is also a factor in terms of it sits together with say value, quality factors that cause the share price to go up. So momentum is one of the validated factors that cause share prices to go up. Okay, or it's actually the reason. Okay, Nivla have a question, but usually the fundamental reason for price to go up when revenue is down is because guidance is better for next quarter. Actually, there can be more than guidance reason. Okay. It could be suddenly the sector becomes very hot, right? It's a sector reason. The revenue is just lagging, right? Because the revenue is past. Sometimes it could be because of merger acquisition, right? So there could be countless reasons, okay, why revenue is down, the share price go up. Okay. But the point is we want both to align so that your probability of win is higher. At the end of the day, investing or trading, there's no 100%. It's more of how do you stack the odds in your favor. That's all. Right? And that's what we are doing here. All right. So let's go back to our momentum concept. Okay. Basically, what is momentum? A share price that go up have a chance to go up some more. A share price that go down will have a chance to go down some more. Okay. Most people think the other way, right? Most people think that a share price go up, it should come down. Most people think that share price go down should come up. Correct or not? Right? But momentum thinks the other way. This is what momentum says. Okay, not this, not this. Right? Is that they will continue in the same direction. Right? To relate it to your experience, for those who have invested before, okay, let me ask you, have you experienced this before? A stock price have come down, you think that's cheap enough, you buy, only to experience the price drop further. How many of you have experienced this before? After you buy, share price drop further. Anyone? Okay, Edwin, Ming Kai. Okay, so these are very common. Yes. How about the other scenario? You saw a stock, well, you think it's a good stock. Stock price is climbing, but you think it's too high, so you don't buy. Only to find that the stock go up another 20%. Experience before? Or even 50%, or even 100%. You think it was expensive, then it doubled. Anyone experienced that before? Okay, Joey say yes, right? Also very common. Okay. Yeah, don't blame yourself. This is normal. Okay. This is normal, right? You can't catch every opportunity out there. But what I'm trying to tell you, what you have experienced is called the momentum effect. Okay, it's the momentum effect, right? Okay, so just remember this: when a stock is moving in one direction, especially when it has the momentum in it, it will continue in the same direction more than it will reverse. Okay, whether is it going up or going down, it will continue in the same direction for a period of time, sometimes longer than what you think is possible. Okay, before the share price decide to come down. Okay, that is what momentum is all about. And in short-term trading, you have to remember this: it's safer to go in the same direction of the price trend than to go against it. Yeah, I say again, in short-term trading, it's more important that you go in the same direction with the share price than to go against it. Okay, a lot of people like to go against the share price one, then get slapped by the market. Okay, the market doesn't care, right? The market moves where it wants to move. Yeah, it's just like in real life, you swim in the same direction of the current, your life is easy. If you swim against the current, good luck to you. Okay, same thing, sailing, same thing, flying, same thing. When you're driving, you got headwind, you will drive slower, right? If you got tailwind, you'll drive faster. Okay, if there's a lot of resistance, you'll go slower. Okay, so basically, trading is about going in the path of least resistance. Okay, get the concept, So it's a very important concept. It's a very simple concept, but it's a very important concept. Okay, a lot of people tend to go against the flow of the market. And that's why they get the direction wrong. Okay. So how then do we measure momentum, right? You look at stock chart, for example, Apple, Microsoft. Some people will say Apple stronger, some people will say Microsoft stronger, and it's very subjective. Okay, so we want a more objective method That's where we call it the regression. This is what we learn in school. Basically, we want to find the gradient. Okay, gradient, which is also known as slope. Yeah, let me ask you. A, B, stock A moves like that, stock B moves like that over the same period of time, right? Which have a stronger trend, A or B? A, right? Because basically it is steeper. Okay, so you can imagine that stock have this trend. You can draw a trend line, or you can call it, this is actually a regression line. And essentially there is a gradient. Y over X is the gradient. Okay, and this is a number. And because this is the number, you can objectively say which have a steeper gradient, which means the steeper gradient is the one with the stronger momentum. Simple. Okay, you want to find stocks with a lot of momentum, a lot of energy, then it can move up, right? If it has no energy, then the price will not move. Okay, it must have that energy in it, and the steepness of the slope will tell you whether the stock has enough energy or not. Okay, and we don't use a line, we use a curve, or we call it an exponential. It's just another fancy name for curve, right? It's the same. Linear is just line. It's another word for line. So we use a curve because it's more responsive. It reacts to price changes faster. Okay, so it will look something like a histogram here. This is what the regression will look like. Okay, and it's measured in percentage. The higher the number, the steeper the slope, basically. Okay, so for example, you can compare because they have, it is meaningless. 80% is meaningless by itself, right? You need to compare with the rest of the stock. If the overall stock market is very bullish, a lot of stocks will be very high in terms of their exponential regression because the stocks all move up, you see. So 80% may not be high. But if the market is not very bullish, 80% might be high. Okay, so it really depends on relative to the rest of the stock market. So this is Pinduoduo or PDD. This was 80%, right? The screenshot was 80%. Okay, and then this is Alibaba, and the regression is -24. Which one is better? Which one has higher momentum? PDD 80% or Alibaba -24%? Which one? Which one? First one, PDD or Baba? Don't know. Just look at number, right? 80% is definitely higher than -24. Okay, so if you have to choose between these two e-commerce stock, you go with the higher regression. Okay, in the short term, the share price is likely to do better, okay, than one that has no momentum at all. Okay, another example, right? This is Elf Beauty cosmetic company, exponential regression 457%. Definitely very steep. Agree? And you look at this, another cosmetic company, Estee Lauder. This is more famous. This is the largest cosmetic company in the world. Okay, the regression is just 2.83%. Okay, so what does that mean? This is in a downtrend, right? You can even see that without regression. This is in the uptrend. Remember what we say? You go with the trend, not trade against the trend. Right? This is better for shorting, not too long. Okay, and to prove to you, okay, you can see that there's also a reason, fundamental reason why the share price is doing better than the other. Estee Lauder grew 5% in terms of revenue growth, but Elf Beauty did 85%. And look at the 1 year stock performance. Okay, one is down 48%, one is up 73%. They are in the same industry. They are based in the same country. And you can see the outcome is very different. Right? So it's also about picking a stock with both FA and TA reasons behind it. Okay, for one, L is revenue growing faster, and the trend or the technical analysis confirm that there's momentum. Estee Lauder, on the other hand, revenue growth is very slow relatively, and the technical analysis confirm that it is in a downtrend. this is a stock to be avoided. So sometimes in life or in trading or investing, knowing what to avoid is already half the battle done already, right? How the battle won already. Okay, otherwise, so many stocks out there. Then every day look at the wrong stock, then think so hard, should I buy or not? Should I buy or not? Then miss the opportunity outside of that stock. Okay. So it's about scanning the market, look for the opportunities. Okay, what are the stars that align and go and invest in those rather than hop on a few stocks that you are familiar with, but they may not be going up in the short term, right? Another example, okay, a lot of F&B outlets, well-known names, McDonald's, Starbucks, Yum Brands, which is KFC, are suffering. Okay, revenue not doing well, stock performance all down. Blue chip companies, well-known companies, okay, and in the short term, they will down some more, right? And Wingstop, on the other hand, achieved high revenue growth. 1 year stock performance went up 93%. Totally different fortunes, same industry. Okay, so again, it's about finding the winner, finding the leader of the industry via fundamental momentum or technical momentum. Okay, example, right? You can see McDonald's exponential regression -14%. There's no strength in the stock. The stock is range bound. If you look at it, it's just sideways. Okay, that's over a span of 2 years. Wingstop, this is what it looks like over a span of more than a year, right? The stock has been climbing more than a year. You say it's high, it go up. You say it's high, it go up. You say it's high, it go up. Okay, momentum 229%. Fundamental momentum. Every quarter report growth and the gap becomes wider and wider. Revenue acceleration. Okay, so I hope you get a picture, right? It's about using this two fundamental and technical momentum to guide us where to focus on. Okay, all right. Where to find this percentage? I use TradingView chart. You all can go and you have TradingView chart is free. You can go and see, but you are limited by the number of indicators you can insert in. Okay, but these are all TradingView charts. Coca-Cola, same thing. Can see not going anywhere. No fundamental momentum, just 2%. Revenue very messy, very choppy. Some quarters better, some quarters worse. Okay, so how do you think this stock has a high chance to go up in the short term? What do you think? Since you all listen to me for a half an hour, what do you think? Unlikely, right? Okay, so then you avoid lah. You will not go up much in the short term one. You know your capital will get stuck, oh. Not that you can invest, you get stuck, prepare to get stuck, oh. Okay, right? And this is Celsius, okay, another beverage company. At that point in time, right? You can still see that regression is higher, so there's still that momentum that's going up, right? It's a bit more volatile, okay, but at least it's going up rather than sideways, right? But the revenue growth profile also not very consistent, okay, in this case, right? Not the best example. But what I wanted to say for the past half an hour is that combine both together, right? Can there be stock that don't have fundamental momentum, have technical momentum and can go up? Can. Okay, but that's not our point again. Our point is have both so that our win probability can go up. Right? Everything is about probability. Yeah. Is there anywhere way we can get FA and TA somewhere or need to do our own analysis? You need to do our own analysis. Okay, unfortunately. All right. Because there are more to it. We are not done yet. Okay. This is just the starting. I hope you get the concept right first, right? The big picture right. Once you get the big picture right or the principles right, then you should be in good hands. Okay. Yes, NIFLA, meme stocks. Yeah. Meme stock actually got fundamental reason. Fundamental reason is that they are being pumped up people. Right? Yeah. But I agree with you lah, it's speculative lah. Okay. If people stop pumping the stock will collapse. Right? Which makes it very risky. And because you don't know when people will stop pumping the stock. Okay. If you get in early, get out, fine. Right? If you get in and you didn't know how to get out, you get stuck. You become a back holder. Okay, very risky lah in that sense. You don't have a lot of control over it. Okay, we are done with which stock to buy. Basically, they must exhibit fundamental and technical momentum. Then your probability of win will go up. Okay, don't just anyhow buy a stock. Don't just buy a stock because you know the stock. Don't buy a stock because you know the name. Right? Don't buy a stock because it's a business that you keep paying money to, right? Because you need to establish that the stock have that two elements, two momentum, twin momentum, then the stock price can go up in the short term. Otherwise, stock price can stay sideways, can go down for a long time, and you get stuck. Okay, so basically the first part is to know not to get stuck and buy a stock that's moving. So step two is when do you then buy it, right? Hey, this is another issue with fundamental analysis. If you use FA to enter, okay, use FA to enter for long term is fine, right? But if you use FA for short term to enter is very wrong because a lot of people can't go away with this, right? That um I want to buy a stock that go up, but I want to buy it cheap. Okay, I don't know whether you can see the oxymoron here, right? Your expectation that is it should go up fast or soon. Okay, at the same time, it's cheap. Okay. Not that it's impossible, it is possible, but most of the time you know that you have if the share price is going up, okay, it's unlikely to be cheap, right? And if the share price is going down and it's cheap, right? Then it will not be going out so fast so soon. You get what I mean? Right? Because now you understand the principle. There is this momentum principle. If it goes in the same direction, it tends to go in the same direction. And which means that you should stop thinking in terms of valuation. In short-term trading, valuation is not required. Okay, because let me ask you, can an overvalued stock become more overvalued? Can or not? In the short term, can or not? Can. Happens all the time, every single day. So you value for what? Because you value already, you say overvalue, don't buy. Then you go up without you. Okay, so don't need to have this concept. Oh, stock is overvalued. In the short term doesn't matter. In the long term it matters. Please, okay, understand the context. Right? Don't let it go away with the idea. Oh, every say valuation not important one. Just whack, just buy. And not true. If you are doing long term investing, which means let's say you hold the stocks for years, right? Valuation needs to be done. But you are just trading it for weeks or months. Valuation is not necessary. Okay, and this is another picture to show you that why FA is very bad at timing. Stock undervalued, you buy, right? Let's say you establish the stock maybe I don't know $250, right? You think that this is the fair price, fair value. Okay, you did your sums, right? Okay, fair value for this stock is 250. At 200, it is undervalued. At 150 is also undervalued. At 100 is also undervalued. At 80 also undervalued. At 60 also undervalued. You know what I'm trying to say, right? So you could be buying at any of these points and only to see the share price go down even more. Okay. And I want to open your mind to this. Right? This is very important. Can a stock, let me ask you, can a stock lose 50% two times? Can a stock lose 50% two times? Yes, does it mean it's zero? Okay, let me ask you again. Can a stock lose 50% three times? Can a stock lose 50% three times? Can, okay, so let me give you the math. Let's say a stock start at $100, so drop 50%, go to $50, correct? Then you say cheap, buy, okay? Then it goes to 25. How much do you lose? You lose 50%. That means you're no different from the guy who bought at 100 and sold at 50. Okay, you get what I mean? You bought at 50, you sold at 25, you lose 50%. The other guy who bought at $100 and sold to you at $50, he lost 50%. You both of you lost the same amount, even though you bought cheaper than him. I don't know how, I think a lot of people don't get the concept. Okay, a lot of people think that I buy lower means I win already. Okay, right? Yeah, like we Peng said, a stock can lose 50% finally. It's true because another guy bought for you $25, he think he's a winner. Then the stock goes to 12.50. That's another 50%. You see, it can continue to drop and drop and drop 50% many times, and the stock doesn't go to zero, you know. You can lose 50% in a stock many, many times. Okay, so you realize actually buying low may not be very safe, right? A stock drop 50% doesn't mean you're safer, The stock can drop another 50%. Right? After a stock drop 2 times 50% doesn't mean it's safer, because you think that unlikely it will drop another 50%. It still can. Mathematically, you can see it happens. And in real life, it actually happens. Okay. You go and take a look at some of the stocks that drop a lot. Okay, like even PayPal dropped 50% more than 2 times already. Okay, so must build this in your brain. Doesn't mean price come down is cheap to buy. It can go lower and lower and lower. All right. So now, when is the safest time to buy the stock? Okay. Now we understand the structure of the price movement, or they call it a stage chart. This is by Stan Weinstein. So he said that there are 4 stages in a price movement. Stage 1, the price is not going anywhere. It has no momentum, just sideways, range bound, consolidation. These are the terms that technical analysis use. And stage 2 is where the stock climbs up, right? There's a trend, upward trend. There is momentum. And stage 3 is also a range bound consolidation period. Stage 1 and 3 are the same, just that 3 is at a high level, 1 is at a low level. And then stage 4 is where the share price go down, and there's also momentum on the other direction, which is going down. Let me ask you, if you long only, that means you buy and sell, okay? You don't short the market, which is the stage that makes you the most money? If you buy and sell, you don't short, which is the stage that makes you the most money? Okay, and we say end of stage 1. Very greedy, you want to get a start. Okay, generally speaking, it's stage 2, right? Agree, right? Okay. It is like a very dumb chart, right? It's like I'm asking you a very stupid question. Yeah, I know, of course, stage 2, still need to ask. Okay. But do you think a lot of people buy in stage 2? Ah, you all agree, right? Stage 2 is the stage where it's best for you to make the most money. Do most people buy in stage 2? No, right? Where do they buy? End of stage 2, stage 3, stage 4. Correct or not? Okay. It's a very simple concept, but I can tell you, right? When humans go to the market, right, we lose our minds, one. Okay, we lose our minds, one. Why? Because at stage 1, what would people say? They are not moving, can go up, meh? Right or not? Can go up, meh? Dead stock, dead. Okay. Then stage 2 is like, this one, bluff one, it will come down, right? Bluff one, come down. Okay, or they may not even be looking at the market, right? Not interesting. Then suddenly here, this part, news start to report. Then friends start to talk about how much money they made, then all the envy comes out. They say, I also must get in. Okay, so they started to get in around end of stage 2, stage 3, never go up. Sometimes they get participate in stage 2, late stage 2, like, see the share price go up, very happy, pump in more money, even more dangerous. Then after that, see the share price go down. Okay, all right, without them exiting, because they don't know how to sell, they don't know how to exit. And some people will say that, finally it crashed, I buy, only to see the stock drop another 50%. Then give up already, don't want to look at the stock anymore, right? Too painful. Okay, so you can see that the logic tell you that stage 2 is the stage that you participate, but your emotions will tell you that other stages are better. That is why people get late, get in late, get out late. Okay, behind the curve, right? So understand that stage two is the only stage that makes money. Don't participate when it's stage one. Don't participate in stage three. Don't participate in stage four, definitely. Wait until the stock is in stage two, then you buy. Very simple, but I can guarantee you a lot of people cannot follow one. Okay, because the emotion overpowers the logic. Okay, just like I say, momentum, go with the flow. I can tell you a lot of people cannot follow one. They must go against the flow one because it feels cheaper. Anything that is going up is expensive, right? Miss the boat. Okay, it's not true. A stock can run a long time, longer than what you think is possible. So the safest place to buy is actually when the stock is going up, not when it's going down, not when it's going sideways. Okay, so stage two is the stage that you want to participate in, right? And you need to establish, that means what stage the stock is in right now. If it's not stage two, don't buy. Simple. Okay. How do you know it's stage two? Right? There are many, many signs, but let me just show you one of them. We can use this as a guideline, right? A moving average, which is a very common technical indicator. Some of you who have done technical analysis, you would have learned moving average. Essentially, it's just a average of all the closing prices of the previous days. For example, if it's a 200-day moving average, it just says that it averaged out the last 200 closing day prices. Okay, and it's moving because every day they will add in a new data because the new day closes, and they will discard the old data, the oldest day data, right? Move with a new one. So when they join all this data together, it becomes like a curve. So what does it mean? Right? Let's use 200 day as a reference for the rest of our session. Okay, it can be other number, it can be 100 day, it can be 150 day, it can be 50 day, doesn't matter. 200 day is the most significant one because 200 day represents a year. Okay, because throughout the year, there's about 200 plus trading days. Okay, so this is a self-fulfilling prophecy also because a lot of technical traders use this critical line. Okay, this is where you determine whether the market is bullish or bearish. For the stock or the market to be bullish, the price must be above the 200-day moving average. If it's below, it is still bearish. Okay, so for stage two, to begin, the share price must minimally be above the 200-day moving average. It cannot be below. If it's below, it's never a stage two. Okay? Can, huh? So, what stage is this stock in? Since you all can understand, it should not be difficult, right? Let's do some exercises. What stock is this stage in? Okay, maybe to help you a bit more. What is this stage? You just tell me the number. The one that I just draw. Stage 3, right? Good. Okay, how about this? You must learn how to identify. 4. Okay. And the red line is the 200-day moving average. Okay. That's your basis. Huh? Right. You can see the price is below the red line. Price is below the red line. What is this stage? 1. Huh? Okay. And this is where the price start to cross above. Right. And then it started to trend like that. This is your stage 2. So which means when the stock is in stage 2, it is look out for entry opportunity. Means can buy already. When the stock is in stage 3, avoid. When the stock is in stage 4, avoid. When the stock is stage 1, avoid. Difficult or not? Not difficult. How about this? What is this stage? Price continue to be below the 200-day moving average. Stage 4, right? Should you buy? No. Okay, this stock doesn't look like have a stage one, then unless you argue this is stage one, then this is your two. Okay, when price start to break above the 200-day moving average, which is the red line, you can see it stays above. And you can see the momentum coming up. And you can see the fundamental momentum, the revenue keep growing. Can you see how it comes together? All right, it's about getting the stars, identify stocks that have the stars aligned, then your chances of success is higher. Okay. How about this? China stock. Stage 3, stage 4, stage 1. Okay, why should you not buy at stage 1? Because you don't know how long it will stay here, get stuck. Sometimes it can stay for many years, man. Okay, wait until it breaks out this part and the share price start to become stage 2. Okay. So what if, of course, theoretically, you'll be thinking that if I buy at the start of stage 2 or when it's early stage 2, right, I will make more money. Okay, which is true. Okay. But what if you identify the stock in middle or even late stage 2, you won't know, right? You think that's middle stage 2 or it's early enough, is it okay or not? Do you think still can buy? Do you think still can buy? For example, the stock come down in front of that. Still can buy or not? This is your 4, this is your 1, this is your 2, right? You miss this part, right? This is maybe the earliest entry. You miss this part. And you are here now. Is it too late? Is it too late? Can, but prepare to exit fast. Okay. How about the rest? Buy small. Well, the issue is when a company first stand on 200-day moving average, how do someone confirm it is sure reversal? You won't know it's for sure one. But remember, is it stage 2 you just buy, or there are a lot of things, there are other things that you look out for? The other things, right? Like what we mentioned just now, technical momentum, fundamental momentum, is it still there or not? Correct? If it's not there, then how? Okay, if it's not there, then don't buy lah. Okay. So a lot of times, sometimes investors or traders, right, when I explain one concept, right, they think that that's the only concept that matters. Okay, remember there is no one strategy that only use one indicator one. Okay, I never seen that before lah. Usually it's a composite or a mixture of indicators or rules, right? And if you're wrong, you must also know when to sell. Okay, yeah, like what Edwin said, right? You must know when to exit. Otherwise, how? You come down, you still stand there and get whacked. The train come at you, you still stand there and wait for the train to hit you. Like you run, right? Agree or not? Okay. So you have to be nimble, especially if you're a trader. Okay, we will know whether is it mid or end. Yes, definitely. Before it end, you will never know one. Okay. In hindsight, everything is clearer, but going forward, you don't know. Okay. So the idea is, as long as in stage 2, the trade can still be put on. Yeah, as long as it's stage 2, right? We established that stage 2 is the best place to make money. As long as stage 2 is okay. As long as not stage 1, stage 3, stage 4. Just focus on the stock that in stage 2. That's the one that's moving right now. Anything else is waste time one. Correct? You can buy 4. How long are you going to wait for it to rebound? You can buy 1. How long are you going to wait until it get out of its low base? Right? Can get stuck for years. Opportunity cost. You can buy stage 3. Your risk has gone up. Only to see the share price drop a lot and you lose a lot of money. Okay, so remember, as long as it's stage 2, it's okay. Whether is it mid, early, whatever lah. Stage 2, you are still safe. Anywhere else is not safe. Okay? Now, this one, you all agree is a stage 2, right? Let me ask you, is it too late to buy? Okay, let me rephrase the question. Do you feel that the stock price is high? See, Michelle say no volume there. I didn't talk about volume. I didn't talk about volume. I rephrase the question already. Do you feel the share price is high? Honestly. Honestly. Okay, YJ say no. Don't feel the share price is high. Let me say check FA valuation. Just now what did I say? In a short term, when you trade short term, do you need to do valuation? Don't need, right? You don't need to do valuation. Got momentum or not? 184%. Got momentum or not? High, but just low momentum. Stiffness. I don't know what stiffness is that. You see a lot of different things that I never mentioned before all come out already. I never mentioned about volume, right? For the past 45 minutes. I in fact specifically say don't need to do valuation, correct? I just talk about whether is it stage two. I talk about whether there's fundamental momentum. I talk about whether there's technical momentum. I didn't show you the fundamental momentum here, lah. Right? But I do show you two of the three things that I talk about already. Okay, which there is lah, right? Is stage two has high momentum. The the question why I ask you, do you feel high or not? Okay, the answer is likely that you feel high. The share price looks high. Okay, because you'll be saying, why don't you buy at $60? Now $130 double already, then you buy. A bit too late, right? Right now, plus 100%. Most people will think like that. Okay. But again, we refer to our rules, our logic. Is it stage two? Yes. Does it have high momentum? Yes. Right. The only thing I never show you is fundamental momentum, but I already passed two of the three criteria. Right? It's a buy. This is a buy. Okay. Then just now what you saw was 130. Now it's 160. The momentum climb up even higher. Share price climb up even higher. You see? Then suddenly look, 130 doesn't look high, right? Because you must also understand a stock chart, right, is a visual construct. It put the share price into a box. Anything that's close to the top of the box, you think that is the ceiling and it should come down. This is a visual trick that our eyes treat it that way and our brain treat it that way. It's not true. This is not a ceiling. I think a lot of people don't realize that. It's our own human interpretation, and because of our screen size, that creates a limitation in our brain. This limitation is not real. It's our imagination. You can see that box can be stretched one. Right? Next one. Is this a buy? Same concept. Is this stage two? Yes. Is it late stage two? Don't know. It could be middle or stage two. It can be even early or stage two. Who knows? By stage two. Momentum is high, 174%. Yes, again, looks high, right? At least 2 years high. Okay. Near the top again. Just remember, this is not real. Okay. From $23, you went all the way to $30. That is $7 over $23. That is like a 30% return, It's not little, okay? It's 30% return in a span of 2 months. Some people hold 2 years also to have 30%. Can you see when the stock is moving, it can really move a lot in a short period of time. And that's what you want. You don't want to waste time waiting. Okay? So this is a very common momentum is very unnatural. It's very unnatural because it goes against your idea of you should buy stock cheap, sell them dear. You should not chase the stock when the share price is high. Correct? Like this graduate, you also feel that yeah, it can be broken, but it's not easy to do so. You see, right? The fear comes in already. What is the upside, right, of this momentum stock? Right? This was during the I think 20, this was 2122 that period or 2 years ago, right? Where inflation was high. And then the rules like flag out all the commodity stock. You can see all these are mostly commodity stock. Some are not, lah, but mostly are commodity stock, oil and gas and things like that. And they were all trading very close to their 1 year high. Okay, so naturally, quite a lot of people feel that it's very unnatural to buy. Right? That's why I say that typically momentum is not human nature to do it. But the thing about investing or trading, you will also realize that anything that feels comfortable, right, is usually wrong one. Anything that relies on emotions is usually wrong one. Because we are not designed to make investment decisions properly. Our brain is not designed that way. Our brain is designed herd instinct. Everybody run, we run. Right? It's not logical one. Okay. But investing and trading, you need logic. And therefore, sometimes the logic will point you to do things that's very uncomfortable. Okay? But you will have a higher chances of winning rather than not. Okay. Right. So why we want to have strategies or have rules is also to help us overcome that emotional bias we may have. Okay. But come back to this, right? Just to prove a point. So in fact, he said it's high, right? Let's look at some of the stock. 2 months later, 3 months later in May. This is in May. Okay. CF industry was $73. It become 107, cross $100 in 2 months' time. Sorry, 3 months' time. ConocoPhillips was $93, become $101, also cross 100. Suncor Energy was $29, become $34. Okay. I hope you understand where I'm trying to drive my point to. Yeah. So what is high can indeed be higher. How about stocks that at all-time high? That means stocks, right, that never trade before so high, right? Or maybe 30 years history, they trade like that. They trade like that. Yeah, I know I draw a bit wiggly lah. Yeah, now they're testing this all-time high. Okay. This is stage two, right? Right or not? Looks like stage two, right? So how? Still can buy or not? The idea is it still stage two? Yes, still can buy. Okay, example, this is Ferrari, right? Of course, sometimes you do not, yes, some minor trends here. Actually, it's not minor because this is a very long-term chart. This is a span of more than 6 years. Okay, you won't, for trading, you won't look at so long. But I just wanted to prove to you this is the all-time high historically. I can see then this is stage 4, then this is stage 1, then this is stage 2 again to test the all-time high. Okay, so it's still 2, momentum is still high. Same concept. Okay, share price went up some more, 56% after you break the all-time high. Yeah, draw the line for your reference. Okay, so sometimes the stock can really go up a lot more than what you think is possible. Like Nvidia, how many people believe that it can go up to $1 trillion market cap in a span of, no, it's almost $3 trillion market cap in a span of 2 years? Nobody. Okay, maybe a handful lah. I don't know lah. Before it runs, right? Okay. Same thing. This is a British technology stock testing the all-time high. This is stage 2, right? Went up another 38% after it cleared the all-time high. Momentum is high. This is Arista Network. Okay, stage 4, stage 2 here. That's the all-time high. Breakout, went up another 93%. Okay. For stocks at all-time high, I will want it to break out and fall back to support before enter. Yes, whichever, right? The detailed entry exit, there are techniques. Okay, but what I'm trying to share with you here is that as long as the stock is in stage 2, it's a it's okay. You are still not too late to buy, even at all-time high. Right? Gold prices, same thing. Break the all-time high, ran this year. Okay. So when a stock break all-time high, right, it's not high, it's actually a very bullish indication. Very, very bullish indication. Okay. So for the whole part of this section, what I want to tell you is to answer this question. When is the best time to buy a stock? You all cannot get this wrong. You all get this wrong, must repeat. It's a very simple concept, but it's very powerful. Right? It will guide you at the right time to buy a stock. Okay, good. Stage two. I don't want to see any number. Okay, please. Then waste my saliva. Okay, good. All right, stage two. Most importantly, you must identify is the stock in stage two. If it's not, don't buy it. Okay. Next one. Very important. Know when to sell. Okay, buying is easy. A lot of people garang guni and buy, never sell one. And then over time, the portfolio will become what 200 stock, 300 stock, almost like S&P 500 itself. Okay, how to manage? Cannot. Okay, so you need to know how to sell. Right? I'll skip this story lah. Okay, I'll skip this story. Uh, let me see. Okay, I'll shortcut the story. Shortcut the story. Okay. So, what I wanted to say, the message, right, is buy and hold, because a lot of people, right, their solution, if they have losses, right, on a stock, their solution is buy and hold. Let me ask you this question. Is does this is this a solution to solve all problem? It's true, right? Because a lot of people, they hold on to their losses and they believe that, oh, just hold long enough, the share price will go up. Is it true? Okay. Hold long enough, share price will go up. No, right? Correct, right? Not true, right? Then why do people keep holding on to their losses? Is it logic or is it emotions? It's emotion, right? Okay. Logic will say no chance sell lah. Right? Like if you buy Nokia stock, how? For the last, let me count so many years. 14 years. The share price has not gone anywhere. How many 14 years do you have in your life for the share price to rebound? Logic will say very little chance. We cannot say no chance. Right? Low chance of rebound. You give another 14 years, it might not be around anymore. Already. Agree? Right? But why do people then hold on to the stock and refuse to sell? It's the emotion, right? Loss aversion. If I don't sell, I still got a chance. If I sell, wow, that means I realize my loss very painful. I confirm no chance. Okay. People will feel that, I'll lose a lot if I sell. Never mind just leave it there Not a lot anyway. Correct. Yeah, but it's a wrong thinking because you know why? Every time you open the portfolio, you see the stock, you feel sad. Every time you open the portfolio again, you see the stock, you feel sad again. It becomes a emotional burden and you cannot move forward. And the more baggage you have, the harder you move forward. I can tell you, you sell the stock, you'll never remember it ever again. Your burden is released already. Okay? A lot of people like to carry this baggage for a long time, longer than is necessary. Logic, they know, deep down, they know should sell, but emotionally, they hang on to it. Okay? And have that glimmer of hope, oh, maybe it will come back again. Who are you lying to? You're lying to yourself. Right? In fact, you already know it already. You don't need someone to tell you. It's painful. But again, we are just reacting emotionally. Okay? So don't carry the baggage, right? I give you another logic here. Let's say you buy Nokia, you lost 90%, right? Okay. Or let's put it a monetary value, you lost $9,000. Okay. You can choose to hold on to it. And let's say you can sell the stock and get back $1,000. Not a lot, lah, right? Because you lose most of it. You can get back $1,000. You can put it in another company. I don't know, ABC company. Okay. And let's say it 9x, 10x, and become $10,000. Right. I know it's a bit far-fetched, lah. Okay. But what I'm trying to explain here is which one do you think have a chance to make back your money? Okay, maybe let's not 10x lah. Okay, that's too much to say. You want to just make another one more thousand. Okay, you put $1,000 to ABC, in double, right? It become $2,000. Or you wait until Nokia become minus $8,000. Okay. Which one do you think you have a better chance to make that additional $1,000? Sell Nokia, switch to another stock and double. Or stick with Nokia. Choice A, choice B. Which one do you think is more logical? Switch, right? Agree or not? Okay. But again, emotions will tell us that, just stick to it. Lah. Don't rock the boat. Lah. Already lose so much already. Sell for what? Right? So, in other words, money is fungible. The logic is money is fungible. Whether you make $1,000 from Nokia or whether you make $1,000 from another stock, it is still $1,000. So what you should do is, where is your best chance to make the next $1,000? Is it sticking with Nokia or is to switch to another stock? And most of the time, the logic is switch to another stock. Okay, again, easy, right? The logic is easy to understand, but we lose our minds in the market. We cannot think clearly. We fall prey into our own emotions. Whether buying, selling, holding, same, at every stage of the way. Okay, buy late, sell late. Yeah, so that is the point of this. I will not go through the story. Okay, what I'm trying to say here is actually majority of the stocks don't do well one. More than 50% of the stock, right, do worse. Okay, more than 50% of stock do worse than a treasury bill. Okay, so actually your chances of picking a stock that will underperform in the long run is higher than you pick an outperforming one. Okay, so that is what risk is all about. Right, your odds are not high to begin with. Okay, so the more you need to know how to sell, because chances are you're gonna pick some nonsense stocks or some underperforming stocks. Everyone, even Warren Buffett also do it. Right? He also make billions of dollars of losses in recent years. Okay, airlines is one, right? Yeah. So Paramount is another one, media company. But he sells and he move on. He don't dwell at his mistake and feel sorry for himself, victimize himself, right? He doesn't solve anything. Okay, he sells. Logically, where's the best place to put the money next? Right? And I cannot understate the amount of emotional burden being released. Okay. Oh, I feel very light after that, right? Because you're ready to move on and deploy the capital. Start afresh. Okay. So there are stocks that after 10 years don't go anywhere one. Okay, Citigroup still not bad, still got gain. Right? Blue chip, blue 3M. After getting dividends, 10 years, lose money one. Okay, Levi Strauss, 10 years, lose money. Okay. So now, when do you sell? Okay. So I give you a very simple idea. It's back to the moving average again. So we'll stick to the 200-day moving average first. It's the red line. Just remember the red line. Okay. The selling concept, there are a few, but just share with you one here. When the price goes below the 200-day moving average, you sell. For example, here, the price go below the 200-day moving average, you sell. Why? Because you can see this is stage 2, right? In this case, right, there isn't really a stage 3. The share price crumble very fast, become like a stage 4. This is almost like a mountain, correct? And there's no stage 3. 2, then 4. But still no problem because you have an exit plan in place. If the share price go below 200-day, I will sell. Why? Because the share price can also go down a lot. If it can come out a lot, it can also go down a lot. And I don't want to get caught in that. The momentum is over if the share price break the moving average. That is the concept. And it's time to call it a day. Because you want to enjoy the momentum, but you must also know when to get out when the momentum ends. So you cannot only buy without knowing when to sell. That is the common mistakes for majority of the people. Hey, this stock can buy, but they don't know how to sell it. Okay? You need to have an exit plan before you even buy a stock. Say again, you need to have an exit plan before you even buy a stock. Okay? So that's how you manage your risk, right? Because you cannot be 100% right one. Okay, sometimes you get in a stock, wow, you realize it's late stage 2. And then the trend reverse, you better get out. Okay. So learn how to sell. And yeah, you don't want to buy a long-term stock and then wrong 10 years later. Very costly. Your capital gets stuck for a long time and still lose money. Okay. Learn how to move on. Yeah, so sell when the price go below the moving average. Okay, simple concept, huh? So in this case, you would sow C at $280. If you don't, today, you hold until today, is $67. Okay. All right. PayPal, you should have sold at $265. Today is $60. Drop 50% loss is 132. Drop another 50% is $61. Can you see? PayPal have dropped 2 times 50% already. Right. Let me ask you, what stage is this? Is it time to buy PayPal? Stage 1, right? Is it time to buy PayPal? No, right? And how long has it been in stage 2? 1.5 years already. Can it get stuck for another 1.5 years? Then you say cheap ma, cheap. Can it get stuck for another 1.5 years in stage 1? Possible. That is why you don't buy in stage 1. You have to let the stock prove itself to you. Okay? Not whether you are worthy for the stock. The stock must be worthy to you. Then you buy. ST Lauder, you have sold based on that principle alone, you have sold at 310 and not hold until today, $100. What is this stage? This is latest price, yesterday's price. What is this stage? 4. Can buy or not? Can buy or not? No, right? So it's very simple concept, but it's very powerful. It can save you a lot of heartaches. It can save you a lot of money. Okay. And selling is not just about cutting loss or whatnot. It's about taking profits as well. Okay. What's the advantage of using a moving average, right? Or any kind of support that moves with the share price? In this case, this is an example using a blue line. This is a 100-day moving average. As I say, the number doesn't matter. You can use any number. between 50 and 200 is fine. So let's say you buy here, okay, right? Because it's in trend, stage two, and the momentum is high. So you bought here and the share price continue to go up, right? Your plan is if the share price go below the blue line, you sell, right? In this case, right? If the share price go below the blue line, you sell. That is your exit plan. And indeed, the share price did well. It continued to go up, right? And as the share price go up, do you realize the blue line also started to go up? What does that mean? That means you are selling higher and higher. You get to sell higher and higher as the share price move up. So in technical terms, this is what they call a trading stock. Okay, right? As long as the share price go higher, you keep holding the stock. Okay, this is important because you don't know when is the high. Just like you don't know where is the rebound, right? Or at the bottom, you don't know where is the high. You need to give room for the share price to fluctuate. You hope the share price don't go below your moving average because if you can hold longer, means your profit is getting bigger and bigger and bigger until the day it goes below sell. Okay, then you make in this case is a 35% over a span of 7 months. Okay, but you can see it's a very clear entry and exit to manage your position and trying to suppress your emotions from overtaking that logic. Okay, so with those sound principle, then you can take the right action. Another example, right? Let's say you buy here, you just keep holding the stock, hold until it goes below. Then you sell. Yes, hold as long as the stock is in trend. Okay, you can see the momentum is still high, right? And you didn't join at the early start, you join in the middle. You still get a 52% over a span of 6 months. Right? Not shabby, what? Okay. And you're out already means your capital is free. You can go for another stock that's running. Nvidia, same thing. Right? You may not need to participate everything. Okay. In this case, let's say you buy here because it start to be stage two, right? You can see it actually was not doing well in 2022 because there was a crash. In 2023, it started the stage two. Okay, let's say you got in, you just hold, come down, sell. That's a 75%. Yeah. So I hope you get a picture. Okay, putting all together, what we learned uh, is actually the characteristics of what I call a turbo stock. Stocks that can move up in the short term. Okay, with a higher probability than not, right? Than other stocks. And when you buy, you want to identify which stock, right? It should have FA and TA momentum. Okay, revenue is growing quarter and quarter. The technical momentum, the regression number is high. Shows that the stock have a lot of energy and relatively the slope is steeper than the rest of the stock. Okay, so you have both FA and TA confirmation. And the best time to buy is to make sure that the stock is in stage two. Not one, not three, not four. The stock must be in stage two. Right? Then lastly, you must have exit plan. Cannot just keep buying on. You must know when to sell. When trend reverses, it can get very ugly and you must get out in time. Okay? Because eventually all momentum will die off. Momentum is not long term. Momentum is a short term concept. Eventually share price will reverse one. And you must know how to exit. Most people don't know. They just hold all the way down. Like they may bought correctly. They may have bought in stage two. But they hold to stage three, hold to stage four. Share price going down already still hold. Right? Because I told you majority of the investors don't know how to sell. Okay, there are actually a few techniques. Using a moving average is was one of them. So you must also know when to sell. So it's a complete process. How to identify which one out of 13,000 stocks, which are the right price, not the right price, at the right timing to buy, and when are you supposed to sell them. Okay. Then after you sold, find another stock that pass all these criteria. You just keep repeating. Okay, you realize that it doesn't involve a lot of emotion. You try to apply logic as much as possible using these rules to guide you to make the decision. Because the moment you start to use your gut feel, you venture into the realm of emotions really. That's where things can get wrong one, where get haywire. Okay. Some example, right? Um, there are two strategies actually, even in short-term trading. There's even a shorter one, which I will share a bit more later. Where you hold just weeks, not months. Okay, the first strategy is holding for months, right? Using the moving average as an exit. Okay, you give more room for fluctuation. But there are those that strategy that you just catch one wave. Okay, maybe I draw visually for you, it's easier to see. So the longer strategy is you let the share price, as long as the general trend is up, you let the share price have enough room to fluctuate. Okay, so you use the moving average. There's a second method where you hug the price closer, right? So you just want to catch one wave of the share price and then you exit. So you buy here, you sell here. Okay, so instead of catching a long wave, you catch the intermediate wave. Okay, that works as well because you're still going along the same trend. Okay, so either you catch the bigger trend or you catch a smaller trend, the concept is the same. Okay, it's just how you enter exit precisely that is different. Okay, these are some examples. I will not go through some of them, right? Yeah, so this example where you catch one wave only. Okay, right. This is also one wave. Catch one wave, out already. Okay, instead of waiting until below moving average. Right. This one was using more moving average. Okay. This also catch one wave. This is the earnings play. This was in fact deliberately bought before the earnings because it was an earnings season that a lot of stocks were jumping up during earnings season. So I thought this could be one. Okay, and historically it has been doing well during earnings, right? Previous quarter was a gap up. Then I bet that this momentum will continue and then it gap up. Okay, once it gap up, sell already. Right, so also catch one wave. Okay. Many example in 2023, this year still have chance got. This year one. Right. This one also catch. This one I bought one day before, no, 1 week before, 7 days. Okay, and then I sold during the Chinese New Year Eve this year. Right, ang pao money. Need to bao ang pao. This is this year as well in March April period. Okay, 1 month. 27. This is also catch one wave. That's it. Okay, you can see the fundamental momentum. You can see the exponential momentum. This is also this year. This was sold 2 months ago. No, 1 month ago, last month. Right. This is using the first method. This is using the moving average. See? Ho, sell. Okay. About 7 months, 36%. I will sell this later. Okay, not holding later. Yeah, I'm gonna sell this. It's about 56%. Okay, bought it December. All right. You say that, hey, actually it's still above ma. Yeah, it went below and went back up. Okay. They got fundamental momentum, right? It's because the exponential regression is too low already. The energy is losing already. Right. So the other exit rule is that when the exponential regression is too low, you have to sell relative to the rest of the stock ranking. Okay. So this is the live trade. I will sell later. So I'll realize the 50% gains. This is still holding. Yesterday, good results. Gap up. Okay. It stays above the blue line, so there's no reason for me to sell. Okay. Yeah, just touching not really going below. Right. Okay. So this is still at 81%. Yeah. But I suspect next week will be a sell. The momentum will come down. Unless it can continue to go up. Then the momentum will go up some more. Right? So you can see sometimes when the price slow down, right? It's almost like look like a stage three, right? Okay. Yeah. But don't need to guess, right? Don't need to guess. Let the share price decide. Why did you buy Spotify when the regression is low? Uh, it wasn't low. It's somewhere around here, right? It wasn't low. I think it got about 60, 70. Okay. It's because this looks very high, right? This point is about 300%. Right? It's just relative lah. It's not lower. Definitely past the ranking then. Okay. But it's getting lower now. So I suspect you get sold next week. Okay, because this got sold this week already. Yeah. Right. So these are most recent example. This is some other short trades. You will realize there's a new indicator here. This is the downtrend channel. So this is basically helping us to catch the wave, the shorter wave. Okay. This was a M&A lah. This eventually got bought over. Right. This was sold last month. Okay. I caught this one wave. April. This wave. Breakout and sold here. Okay, so instead of using the moving average, you can see that this becomes the concept. Once the share price go below the red line, sell. Okay, so you catch one wave. This was a 45% gain in 66 days. Yeah. So it's about a bit like identify that opportunity, go in, opportunity over, get out. Don't overstay. Okay, knowing when to go in and go out. So there are actually two strategies that revolve around here. When to use the blue line and red line? There are a lot more rules to discuss, but we don't have the time to go through every single one of them. Today my purpose is to give you the broad principles, but those broad principles would guide you already in the right direction, right? Buying in the same direction, knowing when to exit, using some form of support like a moving average is one idea. Understand the concept of fundamental technical momentum, combining them together increase your chance. Buying in stage two and not any other stages, right? These are very important foundational concepts. Okay, anything else is just building on top of it, right? The details of entry and exits. Okay, it's just how you finalize your way of entry and exit. Like for example, this kind of the second strategy, you do need to know how to use stop orders, breakout, stop orders, stop loss orders, which you may not be familiar with, right? Because most we are familiar with limit orders. You set $1 means you tell the broker you must feel better than below $1, right? Or $1 at most. When we use a stop order is a different thing. Okay, because in fact we don't want to buy if the share price remain below $1. We want to only to buy when the share price is above $1. So it's a reverse of it. There are entry techniques like this and exit technique like this as well. When you tell the broker that I only want to sell if the price go below this point, right? So the concept is you want it to break certain price resistance. You want to break certain price support in order for you to trigger a buy or a sell. Okay, so the devil is in the details, as I said, but most importantly, you must understand the broad concept. That's what we discussed today. Okay, of course, if you want to learn more, I welcome you to this program, the Turbo Stock Trading course, training program. It has a course inside, and it's a 5-day training where we will go through two strategies. Right, the first strategy where you will allow the share price to fluctuate, give more room, and you hold a longer period. You only need to look at the stock once a week. Okay, you don't need to look at it every day, right? The second strategy, you catch a shorter wave, okay, but you can roll your money faster. Your stop losses, all these are a lot lower, smaller. You can control your risk a lot better, but that requires a bit more time. Once every 2 days, you need to check your position. So there are actually two strategies that comes with this. turbo stock trading program. And over these 5 days, I will give you all the rules that you need, the detailed rules, right? What is step 1, 2, 3, 4, 5, etc., etc. Okay, we don't have the time to do everything today. You can see I need at least 5 sessions to go through that. So that is the course itself, right? But you need more tools to help you succeed, okay? To reduce your research time, to increase your probability of finding good stocks to buy, and all these ideas, right? So these are the bonuses. Bonus one is a fundamental momentum template, okay? For some of the stocks, like US stocks, no problem. The revenue data is there. This strategies can be applied to any stock market in the world, right? For example, I don't just trade US, I also trade the Asian markets. That includes like Singapore, Hong Kong, China, but more Hong Kong, right? The liquidity is good, different hours. And if you look at Asian markets, you won't get the revenue data so readily. Like just now, this stock, see, no data one for the revenue, right? So in this case, you will need to plot yourself. You not plot lah. There is this template. I'll show you how to copy paste, how to get the data for free. Copy paste in this template, and you can see whether the stock got fundamental momentum or not. Okay. And this is the one that has the revenue, right? I'll also show you how to set up the chart. Okay, that looks like something like this, right? Not so many lah, right? You don't need this. You don't need so many lines. You just need 2 lines. Okay, and maybe the Donchen channel. That's it. Right? You may not even need the exponential regression, okay, which I'll explain later. So that is the fundamental momentum template. And the second thing is the exponential regression. Yes, you can use TradingView. You can get this exponential regression chart indicator. Is not a problem. The problem is to know, let's say at 134%, this stock, is this high or is this low? You don't know until you compare with the rest of the stock and you rank them. Okay, so it's tedious if you have to look through 10,000 stock one by one. It's not possible. It's not humanly possible. Or even just a US market, 5,000 stocks, right? How to look at it, 5,000 stocks every week, not possible. And therefore, we have a platform, right, developed with Quant's Cafe, okay, where we will give you the first year for free, right? It's just a subscription, but it's not high subscription. It's optional whether you want to continue or not. We'll give you the first year for free. That's where we rank all the stocks. Okay, one shot, you know whether the stocks are ranking higher than the rest of the stocks out there. And then you don't need to visually see one, right? The rules will tell you, the system will calculate everything for you. You just need to identify which one to buy, and that's it. Okay, so it makes your job a lot easier, especially for a start. Okay, so the momentum screener, right, with the exponential regression put into one system to do the ranking for you, will be included for the first year. The next thing is trade ideas, right? So I look at the markets every day. Okay, for this case, I will do it on a weekly basis. I will tell you, okay, these are the trade ideas I found for this week, right? And which means you don't need to go and do all the work yourself. Yeah, make it easier for you to identify. And you will be able to have these numbers as well, right? Where's the buy, where the stop? This is more for the second strategy. The first strategy, the rules are a lot simpler. Once it passes, you can buy already, regardless what price, right? So the second strategy, you need more precision. I'll give that to you in this case. Okay, this is just some example that the timing was right. So these are the trade ideas. Now I usually do it in a table, okay, because it's easier to see. So you can see there are US, Singapore, Hong Kong stocks. This was April period, right? Every week you get a table like this, and you know exactly where's the price to place the orders and what's your cut loss percentage. And this is for your risk management consideration. Some people are okay with 5% loss, up to a 5% loss. Some people say, okay, I can stretch to 8%. So I included those for you to make a decision. Now, of course, you can feel free to look through the stock and see whether they qualify or not. Okay, and during the earnings season, which is now, I also include these dates to watch out for this. Okay, if the earnings season is good, buy before and you get a spike. Earnings season not good, better don't. Okay, sell before earnings. So it's not every earnings we can play. Okay, this earnings season seems positive, right? Seems positive. Just this Spotify went up, MSCI went up, GE Aerospace went up, Lockheed Martin went up. Okay, so it seems positive, right? It's just the big tech not doing very well. Okay, but a lot of other stocks actually not bad, right? There's a bit of a sector rotation that's going on. Okay, so bonus tree is trade ideas on a weekly basis. You'll get them. And you also get to see the holdings and trades that I've done, so that you know what they are. And even though I give you the weekly trades, doesn't mean I'll enter everything. Okay, and even if I give you the weekly trade, it doesn't mean that all the trades eventually will get triggered because we put a buy stop order. Okay, it also depends on the market whether the share price want to go up or not. If the share price will go up, we won't get triggered. All right. This is the first strategy, okay, where you hold longer period. That's why the profits are bigger, right? So that's a general principle. If you hold shorter, you take one leg up, usually your returns are lower, but the idea is you can free up the capital for the next stock. Okay, so your turnover is faster. Yeah. So this is like a weekly thing. And we do it on a Wednesday, which is today for the first strategy, right? That's why I can tell you I'm going to sell Wingstop already later because it triggered the sell rules, right? There's another stock I'm supposed to sell. I can't remember offhand. Okay. So that is the access to trading portfolio. You will see it on a weekly basis as well, right? Because for trading is very short term. Every week the portfolio can change, right? Especially for the second strategy. Then lastly, you'll be joining this exclusive Facebook group, and it's a secret group, right? So we only add those graduates inside, and that's where I share the trade ideas, I share the market updates, I share the portfolio stuffs there. All right. Okay, CKC says strategy one position trade, strategy two swing trade. Yes, you can put it that way. Okay, you can put it that way. Right. Strategy one is longer. Strategy two is shorter. Okay, so it also depends on your lifestyle, right? If you are very busy, strategy one is better because you only need to look at the stocks once a week. Right? If you're more active, you have more control. Strategy two is better because you can manage your risk tighter. All right, so it depends on your lifestyle, but the major concepts are the same. Trade in the same direction, make sure in stage two, has momentum, have an exit plan. Okay, for both strategy, all these are consistent. All right, so this is the turbo stock trading program. It comes with the course and with fundamental momentum template. This is for you to copy paste the fundamental data if the stock chart doesn't provide, especially for Asian stock. Bonus two is the technical momentum screener. Provide you this for 1 year. This is where it's useful for your strategy one. Okay, because you can just buy off the list. You don't need to screen them separately. Everything is done for you. Bonus three is the stock ideas that I will share with you on a weekly basis, right? Whether be it the first strategy or second strategy, both will have. Uh, for example, for the routine is first strategy will be shared on a Wednesday. Second strategy will be shared on a Sunday, okay, to start off the week. And bonus four is the access to trading portfolio, which I also update on a Wednesday and Sunday respectively. And you get a lifetime membership. There's no recurring fee. Uh, Again, I cannot remember what is the investment for this program. Forgot the program fees already. Okay, if you are interested, you just leave your contact. Okay, we will have a link in the comment box. You just leave your contact. Right. I always forget the fee. I don't know why. Other program I remember. So these are the course dates. They are in October. All right, they're in October. And we can make some arrangement because we have a recording for the first strategy. Okay. Uh, if you want, we can make an exception, right? If you want it earlier, the course dates are fixed. Okay, we will not change the course dates. What I mean is that you can actually start strategy one before the course. Okay, there is a recorded course for strategy one, and we can also give you access to the group first, right? So that you get some of these ideas. Okay, but only for strategy one. Strategy two, I would don't want you to start first. Okay, because strategy two is more complex, it's more advanced. Okay, strategy one is the easier one. You can start with that first, even before the course start. Okay, so that is something I can do for you, right? But you need to let us know. Okay, so if you're interested, you can leave your contact. I don't know the program fee, as I said, you can ask us, right? We can give you the amount. And there's no recurring fee, right? There's no upsell, cross-sell, anything. It is a very simple thing, simple structure. And it's about short-term trading. All right. How long for strategy one, you mean? For strategy one, you can hold for months. Okay, you can hold for months. Strategy one, okay, let me draw again. Okay, strategy, yeah. Okay. Maybe I use a stock chart easier. Just now I talked about the exit plan is a strategy one, right? Yeah, for example, I say I'm going to, this is strategy one, okay? Where, for example, I bought in December, I hold until today, which is 7 months. Okay, that's give you some idea how long that position is, right? I don't care about the weekly up and down, right? You can see the share price actually come down some days, right? I'm not concerned about that because as long as they stay above the 100-day moving average and the momentum is still high, I will hold the stock. Okay, until the stock goes below the 100-day or when the momentum starts to decline too much, then the ranking, they get kicked out, is also a sell. So for Wingstop in this case, it's not because of 100-day moving average. It's because the momentum declined too much. So this is strategy one. Okay. This is strategy two, where I don't buy here and hold all the way. Okay. I just catch one wave. Buy, out. I just catch this one big move and that's it. Done. And in fact, this is longer than normal. This is almost 3 months. I know 2 months. This is 2 months. Usually a month or less out already. Okay. And you control the risk closer. Instead of like for example, risking this amount. Oh, no, sorry, risking this amount of loss. Okay, you're just risking this amount of loss, right, for a big move. Okay, so it's different, right? The entry and exit are different, but the general rule is the same. Stage two, so this is strategy two. Okay, stage two has momentum, all right, in the right trend. Okay, have an entry and exit plan. It's just how do you enter and exit that differentiate strategy one and strategy two. Okay, but you'll learn both in the program. Okay. Need subscription fee for any programs or trading software? Don't need. The only thing is this one. Okay, but it's optional because I will still give you a screenshot. I still give you a screenshot. Some people just use the screenshot, okay, which is fine. You still can do your strategy one. Okay, but you want to continue, I think it's also okay because the fees are not high. I also cannot remember. Okay, yeah, but I think it's cheaper than Netflix. Lower than Netflix. So it's not a significant amount. Right. Other than that, there's no need for subscription. The trading view, you can trading view chart. I'll show you how to set up, which is this chart. Yeah, I'll show you how to set up all the indicators that you need. And you can use a free one. Okay, because TradingView gives you 2 free technical indicators and you only need one fundamental. Okay, more than enough. Right? Okay. But of course, if you want to subscribe to TradingView, it's your preference. Okay. Quant's Cafe, not Stocks Cafe. It's the same guy lah. Evans is doing it lah. Yeah, it's the same, but the subscription is separate. Okay, but anyway, we'll give you the first year free, so you don't worry about it. All right. Okay, so the link is in the comment box. You can leave your contact, you can ping us, you can let us know. Then we can get back to you. All right. I hope today has been useful. Um, as much as possible, I try to explain uh, given the time constraint, right? But definitely I cannot explain every single thing possible. I would need like 5 sessions, 3 hours each at least. Okay. So consider, right, if you are interested in getting onto a more structured process of buying, selling stock, and if you want to also like explore trading, I think this is a good program for you to consider. All right, it encompasses a lot of the sound principles into it with very actionable steps. All right. Do you learn anything today? I hope you do. Okay. So I hope all the best for your investment or trading. All right. And hope to see you around. Okay. Thank you and good night.